Hey, what's up, guys? Thanks for tuning in. In today's video, I was asked to sit down with a realtor partner of mine and friend, Jeff Thibodeau. He's a real estate investor, he's an entrepreneur, and he's got his ears to the ground on the Canadian market. Today's video, we talk about CMHC's new rule changes, how COVID's affected our business, and pre-approvals. I hope you enjoy it.
Okay, so really excited to bring a longtime friend and colleague in the business, Wes, on the show today. He's a mortgage broker, extremely experienced mortgage broker, and we talk a lot on the sidelines about the changes in we can talk candidly, right? Kind of behind the scenes about what all this stuff means. And with big changes coming down to the economy and the mortgage market and the real estate market, thought it'd be a great time to kind of introduce you to my audience. And we can have that same kind of candid talk publicly about all this crap that's happening out there and coming right up to these most recent announcements about the qualifying rules for high ratio mortgages and how that affects, a real viewer here, whether it's a buyer, seller, homeowner. But before we get into that, Wes, I'll give you a few minutes to brag a little bit. I mean, you've had a pretty long, successful career. I know we're both sitting here in ball caps with some beards, but we're pros, right? So tell us a little bit about your career getting into the mortgage industry and how you've grown your business and your team up until today.
Thanks, buddy. Yeah, great to be here. Listen, so I've done this now. This is my 20th year being a mortgage broker. I come from a long line of real estate family members, grandparents, father, all in real estate. So I chose the other route, which is the money side of things. Doing it now like 20 years. I'm with a company, co-own a company called Mortgage Teacher. And we do about $180 million a year in mortgages throughout. We've got a couple agents out in Brantford and Hamilton and London is where it actually was started by my friend Mike. So, very into anything and all things real estate. As you know, into the flipping and rentals and vacation rentals and anything to do with real estate, I'm passionate about. But yeah, it's been a tumultuous career, we'll call it, because it's up and down and up and down. The rule changes now has been very difficult to adapt to for some people, but yeah, I mean, it's been good. It's been good.
And so just so everyone's kind of clear too, like you're an independent broker, which means you represent not only, the full big banks products, but the entire secondary market. And something you and I talk about too, is that you manage your own portfolio of private money too. So through like the whole spectrum of what it means to be like a full service mortgage broker.
Sure. So obviously we're going to deal with, a lot of the big banks that everybody knows and loves. But on the side, we also have, what we try and say is that we don't sell one product. So if you go into a bank, you're selling one product. So TD sells TD's product, RBC sells RBC's product. They fit clients into those boxes. We try to find the client, the box that the client can fit into, as opposed to stuffing into one product. So we go out, we've got 30 different lenders that we can find. A lending, B lending, which is, if you've got slow credit or you can't really conform to all the guidelines that the big banks want. We can help those. We also do a lot of private lending, which you kind of alluded to. And that's where private investors can lend their own funds to help people flipping houses, people paying off debt, people who have maybe been bankrupt, people. It's for anybody. It's for the best of the best and for the lowest credit possible. Private lending is something we're really, really big into. And the rates are much higher. But again, we have a lot of investors who have now started joining our corporation and asking us to get their funds out for them to help. I mean, everybody and anybody that can't conform to the regular guidelines that the banks are offering. So we have a wide variety of people we can help, from, like I say, from the best of the best credit to the lowest. So, it's interesting that to see all the different types of applications brokers can get, where banks are basically, nope, no good, see you later. We say, well, no, but how can we help? Let's figure out a path for you. Even if the answer is no, how can we get you where you need to go, as opposed to just, see you later. So we try and work with clients as long as we can to get them into a house, right?
Yeah, that's what we love about that too, is like again, with the real estate approach too, it's about, hey, what are your needs? And then let's help you go, fulfill those needs. It's the same on the mortgage side. And I think, mortgage and a real estate agent are really two sides of the same coin. And if you're, going to be an investor or you're going to be doing multiple transactions, a lot of the, big bank product is made for the single family homeowner. to just qualify the 2-income job. And then the whole rest of the real estate market is kind of served by guys like you. And I love the name of your company too, the Mortgage Teacher, in that it really runs through. It's not just a name, but like what you just said there on how we're going to try to individually educate people. But also you do the same thing I'm doing here, which is you put out content, you try to keep the public informed. It's not like you got to pay you for this advice. So I love it. And that's why we wanted to have you on the show today.
And you're right, Mortgage Teacher. And it is, we truly believe in it. It sounds hokey, but the truth is when you sit down with somebody who doesn't know anything about anything and you see that light bulb go off and they go, oh, I get it. We love educating. And that's why we are called Mortgage Teachers. So if you don't understand what's happening, we'll sit you down. We'll speak to you, candidly and plainly and until you understand what it is we're trying to do. And again, most of the time, the lenders that we find are paying us. So we're not even charging a fee. 95% of the time, we're not even charging a fee. We're just hoping that client found value and was educated enough to, go out in the world and maybe want to invest in real estate or even just buy their first home. But at least the first-time home buyer now understands the process, rather than just sitting down at a bank, getting sent a mortgage, and now what just happened? I got money, but I don't know anything about it. So we try to educate as best we can, and obviously work with great realtors like yourself to try and help someone's experience be that much greater.
So I'm already my brain's going off in 100 tangents about what we could talk about today, but I want to keep us focused on the current events, right? So
yeah,
obviously the big thing that's happening, it's all over the news, is the COVID situation. And that has really affected the real estate market, but it's also exposed some potential vulnerabilities in the lending market. The governments want to keep things on track. So before we get into the kind of news changes and what was just announced, on the overall, kind of 3 months, 2.5 months into this whole pandemic, what's been the major effect for you as a mortgage broker and your clients out there?
Well, it's funny, when economic times take a downturn, our business actually typically gets busier, because when rates are plummeting like they were, when Bank of Canada made those announcements back to back to back to drop rates, it got everybody kind of in a panic to get out of their current mortgage and maybe refinance to get a much lower interest rate. So we actually stayed relatively busy, if not busier than normal during this pandemic. I mean, it's been unique because lenders have also had to conform to what's happening. So they're asking for more documentation now. So they're asking for a recent pay stub, even though they've already got one. They want another one 2 weeks later, and then they want another one 2 weeks later, because they want to make sure that you're still working.
Right.
And thankfully, a lot of people are going back to work now, which is going to be a little bit easier in our world. But I'd say that was the biggest one. Is obviously people losing their jobs was horrible, and it's affected their ability to obtain a mortgage, especially those who had already purchased a house, already been approved, already had their bank their pay stubs approved, and then the bank says, what? I just want to do a quick double check that they're still working. Now what? So we've had to scramble. But again, brokers, that's what we do. We find ways to make the deal work. We find ways to make the deal close, as opposed to just saying, yeah, too bad, so sad. But yeah, that's been the biggest thing for us, is the change in the way that the lending guidelines within each lender has changed. They have their own sort of guidelines now. So that's been the biggest thing for us, I think, anyways.
Yeah, I think even society-wide, right? That's been the story of COVID, is these instantaneous rule changes without much notice. We were both just joking too about they just announced 1 day ahead of time, short-term rentals are back open, right? Or hey, you can go get your haircut tomorrow or eat at a restaurant. And so it seems like the way that we have to adapt to all these changes and regulation changes in our business is really kind of the value you bring to your client now that you're on top of things and ahead of it. So the big one that's been getting a lot of news, obviously, the Canadian Mortgage and Housing Corporation came out with a report predicting that prices may drop somewhere from 9 to 18%. I made a video about that last week. We'll link up somewhere here. Whether that happens or not, it's just one projection. There's 10 different projections you can read from different economists, but obviously CMHC is in control of some regulations and rules, and they are one of the biggest insurers of high ratio mortgages. Now, let's assume someone knows nothing about what CMHC is. Maybe you can give us a little teacher moment, and then I explain what these changes may mean to them.
Perfect. So CMHC is a default insurer. So a default insurer is literally, they are going to insure the bank's money against you defaulting on your mortgage. So essentially the banks are getting a free ride here. They have no loss if something goes wrong. So what happens is if you put less than 20% down on your mortgage, you require with any lender a default insurer. So CMHC is the biggest one, Canadian Mortgage and Housing Corporation. They're the biggest insurer. I think they have 51% of the market share on all insurers. Now, banks can choose to use, there's two other insurers, CG, Canada Guarantee, and Genworth, and those are also default insurers. And so what they're doing now is they're basically the second approval you have to get. So the bank says yes, but you put less than 20% down, we're going to push this over to the insurance company to have them also approve you. And they have their own guidelines. So they'll say, listen, your credit score has to be X. Your down payment has to come from here. You have to have this much or this much income, and you have been working at your job this long. So they set a criteria. And if the bank follows those criteria, if they check those boxes for their clients, if that client defaults, CMHC will make up any losses, right? So you're paying the bank's insurance. Then they charge a fee, of course, for that, right? So nothing's free in this world. So depending on how much money you put down, 5, 10 to 15%, the lower the risk, the lower the fee. And so the bank will actually add the fee to your mortgage and you'll pay on that. Okay. And that's what the insurer, and now of course they've made the rule change. If you want me to touch on those right now.
Yeah, I'll just maybe summarize that too. Like that's the thing I find most interesting. I think where people are confused is that the banks and the mortgagees, they're in the business of lending money. They want to lend you money. That's how they make money, right? They're not looking at self-regulation a lot. Of course, they want to protect their portfolio. They don't want to have huge losses. But a unique thing in the Canadian marketplace is that our government holds the majority of this default insurance. So when people ask me, is like the housing market about to crash? I go, the number one person who would lose in a housing crash is our central government, right? So it's going to be hard to think that they would let it falter like nationwide, right?
Yeah.
And that's why you see these predictions. Their job is actually to keep that nest egg safe. It's not necessarily to think about how these rules affect the buyer at the end of the day. They're looking at the whole portfolio of all the insurance they own, and they're trying to keep our tax dollars safe. And now, unfortunately, the only levers they have to pull, right, usually affect, first-time home buyers or low down payment home buyers. So let's talk about some of the changes they just put into place, and they're coming due very quickly, right? Not a lot of, yeah. So let's talk about those for a second, and then how does that impact the average buyer, and then how do you get around it if you don't like this news? Right?
Okay, fair. So what a couple of the changes they've made, and they've made a bunch of changes in the last 3 years. So when it's getting harder and harder and harder for a first-time home. Well, it's not directed at first-time home buyers, like you said, but sadly, those are the ones that are going to be affected the most. So when you're putting less than 20% down, you have to have a certain credit score for the bank to say, okay, for the insurer to say, yes, I'm going to go ahead and insure this money for you. It used to be a 600 Beacon score, which is moderate to poor credit. So anybody who's made a couple of hiccups down the road, missed a couple payments on a Visa a couple years ago, they're still going to have the opportunity to be insured, which means they can put 5, 10, or 15% down on their mortgage. That's now gone from 600 to 680, which is a big, big, big jump.
Hey, let's pause there. Yeah, I was just going to say, to me, even that doesn't mean much. What is the life of a 600 person credit score versus 680? Like, how big of a gap is that between those two people?
680, put it this way, when I run somebody's credit for a mortgage and I see 680 pop up, I do, phew, okay, I'm okay. I did, right? I kind of push the button, spin around, and I look at it and I go, good, 680. If it's 600, it means that the credit is traditional. It's a little bit poor. And we don't know if it was a 550 last week. We don't know if it's on its way up, if it's on its way down. So the body of the credit is super important as well. The score is what they look at to say, okay, yes, but they'll still look at the body of the credit and go, well, this guy hasn't made any payments. He was probably a 680 2 months ago, and now he's going down. So so the score is important, but so is the body of the credit of what it's actually reading out to us. But 600 is typically a slower credit. 680 is typically a very good credit. I mean, anything above 700, you're into the exemplary, it's great credit. But 680 is actually very, very good credit. So it's going to affect a lot of first-time home buyers, especially young buyers, because young buyers make mistakes. They haven't been taught a lot about credit, through the education system. So they've made a few blunders here. They've not paid their cell phone bill because it's a cell phone. They've maybe missed a payment late one day on their credit card, and they don't realize how powerful that is. And so those, sadly, are the people who may be affected by this. That's just one of the changes that they made. Do you want me to get into the other change or do you want to lead into that?
Yeah, well, I just wanted to stay on that one for a minute too, because it seems like
Sure.
I haven't really unpacked that either. Because to me, credit scores are these weird numbers. I don't really
Yeah.
understand the way you do, because you're running these numbers and know how they affect someone's application. But so it sounds to me really like it's kind of been a punch to anyone that maybe had a small hiccup in their credit, or maybe
Yeah.
they've just overextended themselves a little bit too far. Probably, maybe even not to their knowing, right? And now, you know, they would have qualified to get an insured mortgage, but now they may not, which means either you can't buy a house, or you have to go into a different mortgage market, or piece together two different products, or just wait until houses are still another 20% higher. Again, it doesn't
That's
seem like it seems like a punch to people that were already maybe going to have a hard time buying their first home in a hot market anyways.
Well, imagine you're on the cusp and you're sitting with a 665 beacon score, which is not that bad. And now you're told, by the way, the money you've been saving, that 5% or 10%, it's not going to work anymore. So you're right. You've either got to put together some sort of package where you borrow the other 10%, or you've got to now go with 20% down, because the only way you're going to be able to get it is to avoid CMHC altogether, or a default insurer altogether. And that's by putting a lot more money down. And when we're talking $400,000, $500,000 properties, that's $80,000 to $100,000 that a first-time home buyer may need to have now because their credit score isn't high enough. And what sucks about that too is people who will say, my credit's excellent, I don't miss payments. And we pull the credit's a 650. And like, well, I thought it'd be a lot higher. Well, here's the problem. Just because you make payments, it doesn't mean your credit's going to be good. If you've got 3 credit cards of 5,000, 5,000, 5,000, and your balances are 5,000, 5,000, 5,000, you're almost your credit score wants to go up because you're making payments, but it keeps hitting the ceiling of utilization because you're fully maxed out. And they don't realize that it matters dramatically that you pay your payments, but it also matters that you're not maxed out, that you're maybe 50 to 60% of your balances, right? Or on your limits, excuse me. So it's really important that people understand that it's not just making your payments. It's making sure that you're not maxed out on, or at least 70 or 60% of your limits you stay within. And that's dramatic. And those poor, souls who have been saving, and all of a sudden they're like, I can't get it. Now there is a light at the end of the tunnel, right? Because because CMHC has moved, the other 2 insurers have not changed their policies. And I had touched on a video the other day that I thought they would follow suit, because with every other policy change, Canada Guarantee and Genworth, which are the 2 other insurers, have always followed suit. But we've been told now that Genworth is not going to follow suit. So there's a light at the end of the tunnel, I think.
So this is a really, really interesting, I mean, for real estate mortgage geeks like us, this is an interesting move, right? Because usually you have CMHC setting the policy, and then the other 2 non-government agencies just following along, right? And running the same policy. And it's kind of a fair market. It's kind of like who can schmooze who to get the business, right? But right now, with this really fundamental decision that, okay, CMHC is going to like hedge its bet and say maybe we're too overextended, or maybe we're too fearful, you've got these other 2 people must be reading different reports or doing different research, right?
Or not just
pressure.
Yeah, I mean, and I think, and you mentioned it, Jeff, like, lenders want to lend money. They're in the business to lend money. And so when a lot of their buyers are no longer able to get financing because of this insurance, it's going to allow Genworth and CG to get a little bit more of that market share. It's going to allow some of the lenders to say, you know what, maybe we won't use CMHC as our default insurer on these ones. Maybe we'll switch over to Genworth. Maybe we'll use Canada Guarantee. And so their market share will go up. And I think that's part of the reason why they're not going to follow suit, is they want part of that market share. And listen, these other companies do their numbers too. They know the default rates. They know their risk tolerance. They know where they're at. And so I think they look at it and go, we don't see it as being as bleak and as dreary as CMHC has said it is. So we're going to go ahead and take a shot in the dark here and just keep things status quo for now. And I think that will help a lot of buyers. Some lenders will choose not to use Genworth. Some lenders will choose, they want that 100% guarantee through CMHC, and they're going to stick with that. But it's going to allow other lenders to go, well, listen, now it's our turn as lenders to get more market share, to get more loans out. So I mean, it's not all doom and gloom. Yeah.
Yeah. I mean, I think the more you keep saying, like, we talk to real estate clients, like, if you're going to sell your house in an ideal world, you should be talking to me 3 to 6 months in advance, right? So we can pipeline the changes, the plans, the timing of it all. It seems like the really the same story, yet unfortunately, a lot of the time, especially for first-time home buyers, sometimes the mortgage step is like after we've already found the house we love, right?
That's how it
Like
happens a
how
lot.
early in an ideal world, like new client, you know, run their credit, start teaching them some things, get them in the ready. How early would you love they called you instead of, hey, I just found my dream home?
Listen, I would love, like you said, I would love 6 months, because what that's going to do is this. A, if you're ready to go, we run everything. The good news is maybe you can buy sooner because you're set. Your credit's good. Your income's good. Your down payment's sorted. You can buy now. But if it isn't, we might need 3 to 4 to 5 to 6 months to get your credit score better. You might not have realized that, hey, maxing out your credit cards is hurting your score. And now your score is too low. So if we have that time, and imagine, they go to you to find their dream home, and people call me the dream killer. And that sucks, because I'm the guy that says, by the way, that home that Jeff just showed you that you love and you're going to plan a family there, you can't have it.
Right.
And that stinks. I always say that I hate being a dream killer, but here's the facts. But we're going to work with you to get you in that home that Jeff found. We're going to work with you to find another home like that, because 6 months gives us enough time to assess the situation and get them on their way if they need it. If they don't, they can buy sooner. They can get on the hop and go.
Right. And there's even kind of little steps, because again, people don't realize that all this credit reporting, it's all very algorithmic. Like the way Facebook decides what post to show you, it doesn't know you as a person. It just knows the reporting stats and how to build that into a credit score. But a guy like Wes understands what all those behaviors are. And just by tweaking a few of them, change those ratios, change those numbers to get you in a place where you look now like an A client, because some of your behaviors may have been making you look like a B or C client. And that could mean tens of thousands of dollars in interest rates, or even buying or not buying a house, right?
That's the biggest one. Maybe you're not going to get in the market now, right? And maybe because, and again, when it comes to credit too, people are sadly not educated enough to understand that when you go out and get a brand new car, that payment is going to affect your ability to get a mortgage. But they don't realize that. Like, I have great credit. I can get any money I want because I have such good credit. Well, the truth is, that's not really how it works. And so that 6 month in advance, we'll say, listen, here's your choice. You can either sell that car, or you can buy or keep it and not get a house. So we've got 6 months to figure that out, right? And I've had that many, many, many times where they say, geez, I wish I hadn't bought that car. I wish I hadn't have done that, because I would have been able to get into a house right now. So yeah, 6 months is an amazing, it's, I think, enough time for us to sort out the situation and get them well on their way and direct them and have a path so that they know what their path is. We try to send out an email synopsis to say, hey, listen, here's what we talked about. Here's what you got to do. Stick to the plan and we'll get you into a house.
Yeah, I mean, mortgage lending is such a powerful tool that allows for wealth creation, whether it's in your primary residence or whether it's in investing. But it's complicated too, right? For the average person. So you need someone on your side that's going to look at your whole goals. Like, and even if it is to buy a house and then buy an investment, there's a different path in what you should do and how your book should look and everything like that. So, man, I really appreciate this. I think, why don't we cap it off with, hey, it's June 11th when we're recording this, right? Thinking about the next 2 or 3 weeks, obviously the real estate markets are super hot in most medium-sized cities. We've got this inventory shortage. We've got 5-year fixed rates coming in the lowest ever. We got rule changes. Like, if I'm calling you today about buying or selling a house, like, what's your 30-second hot take on advice for your clients right now? What's happening?
As far as how to get into a house, or what my thought?
Yeah, maybe first time buyer, or someone's calling you about, should I refi? Like, what are the big questions you're answering right now?
So right now, refinances are huge. Rates are, like you said, they're at absolute ridiculously low amount. I call it free money. I mean, anything that starts with a 2, if you have a 2.6, 2.7, 2.5, I mean, that is free money. It's so cheap. So we're getting a lot of people who want to refinance to pay out a lot of debt. So yeah, we're telling people, listen, if you've got a lot of debt on the left side of your ledger that's at 10%, 12%, 14%, let's roll into the mortgage. You're not going backwards, right? It's debt is debt is debt is debt, no matter where it sits. So let's get into the mortgage. Let's get 2.59%. And we're doing a lot of the refinance to get them situated, especially during COVID when things are so uncertain. Let's get you financially secured on a monthly basis. Let's lower the monthly cost. Let's lower the interest. And if people wanted to get into the housing market, it's always, let's get pre-approved. Let's look at your buying power, your affordability first, and then go see Jeff, right?
Amazing. Yeah, I think there's a real opportunity for people right now to, even if you hadn't really thought of refinance as part of your normal process, you kind of just lock your mortgage in and pay it off. You should give Wes a call and just explore it, because it could open up purchasing power that you didn't even know you had, or like you said, build that safety net now in case of an economic issue coming down the road. All kinds of things. I really do think, a good mortgage advisor is part of your lifelong financial team. And then of course, the biggest thing I tell people is, once you get down with a good mortgage broker and get pre-approved, then you've got that. If the rules change, you're ahead of the game. And if they change for the better, they'll just give you a new pre-approval. But if they change from the worse, you've usually got a better window than someone who hasn't started the process to actually execute on that better product. We're at the bottom pretty much of where things can go, right? They're not going to go much lower. So this is the time to lock something in, so that if things do start to nudge back up, the economy starts to recover, they're going to nudge that interest rate back up, and you want to have locked in today. So man, I really appreciate the time you took today, sharing all this with us. If people were looking to, obviously we're going to link everything up, but where's the best place to follow you and get more of this advice?
Well, Wes Paul's, my Facebook page, Mortgage Teacher, Wes Paul's the Mortgage Teacher, at Wes Paul's Instagram. Those are the two places you'll be able to get a hold of me. wespauls.com is our website. You can go in there. We write blogs. We have some information on there for people to read who are looking to get into maybe private lending, or to refinance their property, or to buy a rental property. As we mentioned, I'm into rental property, so I've got a lot of strategies on how to utilize equity to buy more property to build wealth. So we do a lot of that with people as well, trying to help them build that. But yeah, wespauls.com, and we love to hear from you.
And guys, I've known Wes before I was even a real estate agent. So it's coming up on we met like so young. I remember
a long time.
Yeah, forever ago. And so I've been able to watch Wes's whole career, and I know, these videos, people, you could potentially be watching this coast to coast. Feel free to reach out. He's going to give you really solid advice. And if he can't help you because of your geography or your situation, he's going to refer you to somebody else who can. I've seen this guy, time and time again, do the right thing by his clients. So if you even need a comment, reply to me and I'll forward it over to Wes. But, thanks a lot. And we look forward to having you back on the show for some other things. I think you've sparked that our next interview should be talking about, how to pick up your second property with nothing, right? No cash, take advantage of this upward market we've had for the last 5 to 10 years. Not all this doom and gloom, but how to use that equity, potentially accelerate your retirement, accelerate your future. So thanks a lot, Wes. Appreciate the time. Have an awesome day.
I appreciate it, buddy. Thanks a lot. That was great. Big thanks to Jeff Thibodeau. Thanks a lot for having me in your video. I really enjoyed that. It's always nice catching up with old friends. And Jeff's a great entrepreneur and a great real estate investor, so has a lot of knowledge that you can learn a lot from Jeff. So check out his YouTube channel. And as well, guys, if you liked that video, if it was giving any value, I'd love you to hit that like button. Please hit subscribe for more videos like this one. Anything to do with real estate, the real estate market, real estate investing, and all things mortgages. I'll see you soon.